Hey traders, this is Blake Morrow with Trader Summit, and I have George Pearkes, global macro strategist at Bespoke Investment Group. Once again, love having you here. How are you doing today, George?
Good. Yeah, excited. We had a big week with Jackson Hole, and we got a big jobs report coming up tomorrow, so lots to talk about.
You're right. There is a lot to talk about, and just kind of revisiting Jackson Hole really quick. I think a lot of people have they came to Jackson Hole thinking that the Fed, for some reason, may be a little bit more dovish. I was one of those people, by the way. I was positioned for, okay, maybe he says something that signals not quite as hawkish, but he came out pretty hawkish. What's your breakdown of the Fed's messaging to the markets post Jackson Hole?
So I think we have to go back to the July FOMC to really understand the context of what happened at Jackson Hole. Coming out of the July FOMC, the big thing that everyone was focused on was this idea that eventually the Fed was going to slow down the pace of rate hikes, and they explicitly said that eventually we'll get to the point where. And I think people took that as them foaming the runway for an actual change in policy stance. That is slower pace of rate hikes, leading eventually to cuts. And the problem was that that's not what they meant. I think it was very poor communication to put that into what was said in July. By Chair Powell in the press conference, and I think including it in the minutes as well, it was not a constructive signal to send, because the market wildly over extrapolated what it meant. You saw a very large rally in equity markets, credit markets. You saw lower yields. You saw a weaker dollar, just generally looser financial conditions off of the back of that, which was not what the Fed wanted. And we know that's not what they wanted, because they came out of Jackson Hole and said, "Hey, no, guys, this is not what we're looking for at all. Right. Y'all are way over your skis on this. This is not where we are." And you could get that from Chair Powell. You could get that from Cleveland Fed President Mester. You could get that from KC Fed President George. You could get that from Minneapolis Fed President Kashkari. They all came out and just said, this is not at all what we were looking for. And every piece of explicit guidance around what FOMC members were looking for was more hawkish than what's currently priced in the market. That takes two forms, both in terms of the peak terminal rate that we're going to see probably next year. 2023 is probably when we're going to see the highest rate for this cycle. And in terms of how long we'll be at that terminal rate for. So the FOMC's message is very, very clear that they want to take rates to at least what's priced by the market, and probably above it, maybe not substantially above it, but probably above it, and that they want to keep rates there for a long time, before, relatively long time, talking multiple quarters at least, not just a quick hike and then start cutting immediately. I don't agree with the assumptions from Chair Powell and from the rest of the FOMC that the current inflationary backdrop justifies a tightening cycle that wrings inflation out of the economy. I think there's just too many supply side cross currents to justify a read that inflation has come unanchored. If we look at inflation expectations, if we look at market pricing of inflation, if we look at where we're seeing inflation in the economy, I just don't think you can justify analytically a view that we're we could be at the start of the 1970s redux. But at the same time, if you do take that view that inflation is broad enough and has enough momentum, and that we're going to see that sort of huge inflationary spiral if the Fed doesn't wring it out early and stamp it on it early, then their policy perspective is pretty justified. And if that's the case, and you've gotten reinforced information on that, then short-term rates are going higher, real yields are going higher, the dollar's going higher, commodities are going lower, risk assets are going lower. It's just, you don't fight the Fed. And so that's sort of where.
And I was going to ask you, where do you stand on this? I know you're kind of playing well, if you have this view, but what's your personal view? I mean, and obviously the market's falling into line with that, as we have the dollar yen at new highs. You got the dollar index, the euro slipping back down towards below parity once again. Gold's weakening, yields are rallying. So where do you fall on that?
Yeah, so I think inflation is in the process of peaking right now. was strongly of the view that we weren't going to see high inflation as prolonged as we have, especially on the supply chain side. That view was obviously wrong. And I think anybody that was forecasting headline inflation has been wrong this year straight up, because the impact of the war in Ukraine has been so huge. And, nobody forecasted that. I mean, I'm sure someone somewhere will say, oh, I forecasted that. Okay, fine.
Yeah.
Reliable forecasts that were actually grounded in reality. No one thought Putin was going to invade. It was totally contrary to all his interests, and he did it anyways. So, that has really thrown a wrench in inflation forecasting this year. And I think that dynamic, that geopolitical dynamic, the dynamic of supply chains still being the source of a lot of the inflation we're seeing, but the incremental news there being very positive. And the fact that if you do a component breakdown of inflation, like, we're just not seeing the sort of inflation that you would see in a wage price spiral. We're seeing lagged effects from things that we already know took place. Rents are a really good example of that. We're seeing idiosyncratic supply chain issues in specific goods markets. Used autos and durable goods ex autos are great examples of that. We're seeing food price inflation that we know based on futures markets has peaked and will decelerate in the coming year. There's a whole bunch of different stories you can tell about why we're sort of through the worst. Now, mechanically, core inflation is going to stay pretty high for a while because of how the BLS collects data around rent, and because rent is such a huge part of core inflation. It's going to run probably 50% above, or maybe 2/3 above, not 50% change, but the contribution that it's going to be making to the headline, or to the core index, is probably going to be about 50% higher, or maybe a little bit more than that, higher than what would be consistent with 2% core inflation for the next couple of quarters. It's really hard mechanically, based on how those price collections work, to get down to a rent inflation level that's consistent with 2% core CPI. That said, if you strip out, if you have a bunch of core CPI components that are saying, like, look, things are getting better, we're actually seeing outright deflation, which is what we can very much expect, I think, based on the last few months of data. You've got food and energy prices that are deflating, definitely the case. We're in the midst of the second longest decline in national average gas price changes in history. So, if you see those pressures abating, and that the only thing that's still going up and still punching way above where you want for core inflation is something that's mechanically lagged, then I think you can make the case that we're actually in a much better place with inflation. The problem from the FOMC's perspective is that they don't believe that. They basically if you think about a boxer who takes, a jab early, or an uppercut early, they're going to be looking for that same punch the rest of the fight, right? They're going to continue to be looking for that punch. And that may actually be a problem for them, because while they're busy, keeping their hands in position for that punch, they can get hit by another punch. You can't block everything at once. So I think that's the problem for the FOMC, is that they're hyper focused on this idea that inflation is way above target, continuing to spiral. They need to stamp it out. That's the only thing that matters. And if inflation doesn't continue to accelerate in that way, then they're going to be in the wrong position. And I think that's probably the baseline expectation. So that's why I'm a pretty firm believer we're headed for a US recession. The Treasury yield curve is very, very clear in its signal in that respect as well.
Yeah.
Haven't locked it in from a Treasury yield curve perspective, but the odds of recession are very high, far higher than any other period that we've seen in the last 20 or 30 years that hasn't actually gone into recession after. So, I think that's the baseline expectation. The dollar is extraordinarily strong, and we haven't seen that really hit US manufacturing yet. It will. It's going to. It's coming. There's just all these different cross currents that are gonna hit. The good news is labor markets are still strong. And as we look ahead to tomorrow, non-farm payrolls tomorrow are expected to rise
About 300,000.
298,000.
Yeah.
300,000, call it, after 530,000, 528,000 in July. I don't see a reason to disagree with that forecast. We've seen improved numbers from initial jobless claims over the past couple of weeks. Clearly, we're seeing some sectors of the economy slow down their labor demand, but overall, in aggregate, things are still strong enough that it should be fine for the time being. And so that's just one more thing that is going to convince the Fed that we're in a cost push inflation and a wage price spiral issue here, even though that's not showing up in the wage data.
So George, when you're talking about you're talking about NFP and the jobs report that's coming in tomorrow, when you're talking about jobs, people are going to be, and just to make sure everybody's clear, you're going to probably be watching this after the jobs report. You think the jobs report is going to come in probably around in line, at least continue to stay relatively strong. But at what point do jobs really, even being a lagging indicator, when do they start to show some signs of weakness as we head into that possible recession that you may think happen towards the end of this year, or maybe the first quarter of next year? When did the jobs start to show that weakness?
I mean, they're going to slow down roughly at the same time that output slows down, and trend output slows down, not just, output as defined by inventories, but consumer spending, business investment. When they start really slowing down, that's when you see jobs start to dry up. And we've seen that in some sectors, in some parts of the economy already that were admittedly very, very hot. So for instance, tech, right? These business models that were dependent on large infusions of investor capital at extremely low discount rates. Those sectors are basically not hiring with reckless abandon anymore, and in fact are in aggregate probably cutting jobs at this point. That's a relatively small slice of the labor market. The more important part of the labor market is I think a better way to refer to it is like the stuff economy, like the real economy. There we just haven't seen a slowdown in demand yet. Given how strong consumer spending has been, and given how consumer incomes are probably not running as fast as is necessary to keep up with the current pace of consumer spending, especially in the context of rising interest rates and falling fiscal policy supports. I think we're going to start to see that turn in the labor market as we move into Q4. The good news is for the labor market, we have a very, very high frequency, very, very stable indicator of how the labor market looks in the form of continuing and initial jobless claims data. I mean, that data is very, very quick, and it shows you what's going on. We've also, I would point out, got a lag between the housing market, which despite being a relatively modest share of overall economic activity in the US, some prognosticators and forecasters describe it as, the US housing economy is the US economy. And the reason is that it's so cyclical, and it has so many knock-on effects in terms of consumer wealth effects, in terms of goods demand, in terms of demand for services. A dollar spent on housing has huge knock-on effects, and housing is getting creamed right now, and there's no daylight at all in sight. Mortgage rates are back to about 6%. Yeah. And at those mortgage rates, and with the current housing market price backdrop, the activity is just dead. We're headed towards a 5 million annualized pace for existing plus new home sales combined. That isn't a perfect proxy for GDP contributions, but if you look at, for instance, housing starts, housing permits, the number of units under construction is going to start falling as backlogs get worked through. And then after a lag, after the huge backlog we've had of houses that were started but not yet completed because of supply chains, because of just the scale that the industry was operating at, those will get chewed through, and that's when the layoffs start. So, those sorts of layoffs are, I think, in large part booked in for, maybe the first half of next year, something like that, as that backlog falls. And as that backlog falls, then that's going to have knock-on effects into goods industries as well, manufacturers that supply the housing market, so on and so forth. I
was going to ask you really quick. I didn't plan on talking about the housing market, but a lot of, if you're on social media, if you see a lot of, some of the videos on YouTube, everybody's like forecasting some sort of housing collapse. And do you see it like that? Because we're structured a lot differently now, post-pandemic, from a banking point of view, from a lending point of view, than we were during the 2008 timeframe. However, prices have raced up obviously quite quickly due to the pandemic. Yes. So what do you think?
Yeah, so housing prices will fall nationally. The question is how much. Falling housing prices nationally is extraordinarily unusual from a history perspective. Basically, the only time it's happened is after the subprime crisis and global financial crisis, 2007 to 2012, that kind of time frame. Yeah. The magnitude of declines is an open question. Probably not very large. And talking like a 5% haircut or maybe a 10% haircut on national home prices would sort of be the worst case scenario for me. And given, for the vast majority of people that own their homes, that's not a problem. Like it is straight up not a problem. They have tons of equity. They have very stable cash flow, cash needs that they need to cover in terms of their debt servicing. Underwriting standards on mortgage loans today or over the past couple of years compared to the early 2000s are not comparable. I mean, it's
right? Yeah.
Completely. So, there's going to be a huge slowdown in the economic activity related to housing markets. So the number of transactions and the brokerage that gets paid on those transactions, people investing in their home through upgrades to furniture or remodels, that sort of stuff. The number of homes built and, the number of homes that are sort of in that supply chain. All of that is going to slow and probably quite dramatically. The thing is, like, that's not the same thing as a debt crisis, which is what we had the last time around. US households are even at the current interest rates, like, just keep in mind, like, if you take out a 30-year mortgage like I did in 2019 to buy your house, and the current mortgage rate goes from, I don't know, 4% to 6%, that doesn't change your monthly payment if you've got a 30-year fixed rate mortgage. But I mean,
which is a majority of Americans. I mean, just recently, I know some lenders have introduced, adjustable rate mortgages, but that's not really too common practice and widespread. Correct me if I'm wrong.
7/1 arms are reasonably common for and sort of higher like jumbo loans. We'll see adjustable rate mortgages. You definitely see some interest only loans. The thing is, when you're doing those kinds of mortgages, A, the underwriting is completely different, and B, a 7/1 arm is not the same thing as like a balloon payment loan where you're doing interest only and or doing a teaser interest rate that amortizes to the principal, and then you get a balloon payment when you go to a floating rate. Like that's not how any of that stuff works. 7/1 arms they're a relatively small share of the total housing market, and they're very, very manageable in terms of the interest rate risk there that households face and the adjustments that they face. So rates crush housing by they'll reduce housing prices, and they will make the marginal buyer able to spend less on housing because the mortgage rate is higher, so they have a lower budget, all else equal. But the feed through effect that has to the balance sheets of households that have stable debt coverage ratios, that have ridden an appreciation boom but not taken huge amounts out. There has been equity withdrawal, but it's been relatively modest compared to the size of equity creation from the housing price boom during COVID. It just the cash flow issues are not going to be there. So we'll see a national home price decline, I think, and we'll see a very steep decline in activity associated with housing. But that is very different from anything like what we saw in the last housing crisis.
All right. Well, that great answer, and thanks for addressing that. By the way, if you're watching George at home, George, we haven't had you on here in several months. It's really nice to have you back. If you like what you're seeing here on YouTube, make sure you give George a big thumbs up. Subscribe to the channel so you don't miss any of this content. But George, this is the Traders Summit. We talk about kind of where to position ourselves in the market from your point of view. And from Bespoke's, maybe your just personal point of view, where do you think is the best place to be right now, based on what you've told us with potential recession coming? You see the dollar is really strong, precious metals are weak, bond yields are, continuing to rally, which is a surprise to a lot of investors. Where do you see the best opportunities right now yourself?
I really think the risk premiums that are being baked into the treasury market, I mean, we're seeing it today. This morning, someone got their face ripped off in treasuries. Like the 2s10s curve just went to the moon over the course of like 15 minutes this morning. Like you could tell someone was in a flattener and just got stopped out heavily. That kind of price action where you're seeing people just getting tapped out, and that sort of aggressive swings in not just the level of rates, but also the term structure. At 3.4%, a 30-year bond, to me, I mean, the risk reward there is completely different from, with the 2-year at 3.5% is completely different from where we were, with 2-year yields at 50 basis points and, the long bond at 2%. I really think being overweight duration makes a ton of sense, and whether that's through treasuries or if you want to, clip some extra coupons and do that in the investment grade bond market too. We've liked investment grade high duration positions most of this year. And with the curve flattening so aggressively, there is clearly a lot more bid overhead at 3.5% yields on the long bond than there is with 2-year yields hitting 2.5%. So from our perspective, being overweight duration makes a ton of sense. I think the dollar too, continuing to remain long the dollar makes a ton of sense as well. A lot of Europe's energy woes are going to be dependent on the weather this winter. How bad it gets is really going to depend on what the weather comes in as. But if we see a really bad European winter and the wheels really come off energy markets there and real political stress, you could see a 90-cent euro US dollar rate in a very, very big hurry. You could see pounds trading below parity, no problem.
Wow.
Like that to me is a totally realistic outcome. It's not locked in, obviously. Like I can't predict the weather, no one can, but
right.
That's the skew there, I think, is pretty big. And I just don't see what's going to get in the way of the dollar continuing this run, given that the Fed has just said no, we want to restrict US economic activity dramatically. They want a stronger dollar. The rest of the world wants a stronger dollar because of the various energy risks and what that does to their domestic picture. They want to support activity however they can. So I'm pretty skeptical that the dollar can turn in a sustained rally or sustained sell-off at any point. So long bonds, long the dollar, and then being opportunistic with commodity positioning. With equities, I think we've I don't see like another 30% downside from here. I think there's downside risk, and I'd probably guess we set a new bear market low at some point. How much lower is an open question. And then in credit, staying overweight stuff that's higher quality as opposed to lower quality companies. I think as these rate rises continue to bite, you're really going to see some companies get into difficulty that cannot handle 3.5% policy rates as the sort of cost of debt. So definitely favoring anything that's higher quality over anything that's higher leverage. That's a trade we like a lot. So yeah, I think that's sort of the basic approach that we would take, and obviously you can get more granular from there, but from a high level, that's where we're at.
Great, George. I love chatting with you. As I told you when we first did our very first interview together, I followed you around on Twitter for many years. You're kind of like that smartest guy in the room. I always like to watch and read your conversations. So as a trader, if this is the first time me listening to you, how do I follow your work?
You can find me on Twitter at Pearkes, at Pearkes. I also publish my research at bespokepremium.com. So Bespoke Investment Group on Twitter is at Bespoke Invest. That's where all my stuff gets published. I do a morning note, a night note, weekly fixed income note, bunch of other stuff. So if you have any interest, that's where to find me, bespokepremium.com, or follow on Twitter. Yeah.
Well, I'm a big fan of your work, and I'm sure many more people are as of this video as we conclude. So, George, thanks for joining us. Good luck as you head into the fall. I hope the weather peaks there in North Carolina, and it gets a little bit better for you.
We're ready for the fall, that's for sure. Except for my leaf blower. My leaf blower is not ready for the fall.
All right, George. Have a great day, and we'll talk to you soon.
Thanks, Blake. Good to talk to you.
Good to talk to you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.